Hi, I'm Brett Warren from Metropole. What price would you be willing to pay to become a successful property investor? Let's face it, after a decade of record low interest rates and low levels of inflation, holding a property has been relatively simple. While there's been the ups and downs of a normal property cycle with a pandemic thrown in, it's been more about holding your nerve than anything else. But the tide is now turning rather quickly, with rapid fire interest rate rises and inflation shooting to record levels. The cost of holding a property is also increasing. My advice, prepare to get comfortable being uncomfortable. Many investors are going to panic and not stay the course, choosing to exit if things just become too uncomfortable. Others will avoid investing altogether, and many will target properties that are perceived to be neutral or positively geared to minimise damage, and that will be a mistake. There is a price to pay initially to become a property investor, or you may find a higher cost later in life, being your financial freedom. Here are my thoughts on how to get through this stage of the cycle. As I said, the first thing to understand is this is the new world order: higher interest rates and higher inflation for at least the short to medium term. But like everything else, this too shall pass. So it's about building a bridge to get to the other side. It's not about panicking and selling up. Most sophisticated investors understand it's time in the market, preferably decades. So the focus needs to be about holding good investment grade assets over decades. So if you find holding costs increasing, what are your options other than selling? The first thing is have a chat to your broker, have a chat to your bank. The most obvious one is to get a lower interest rate, and that can be done by calling and speaking to someone who may be able to assist you. It's not always the case. The other thing, consider switching from principal and interest over to interest only. Remember, the focus is to hold this asset for the short to medium term without selling. So changing the structure of the loan and paying interest only may close that gap and allow you to hold that property for the short to medium term. And later on, when rents rise and things happen and you work out in a better situation, switch back to principal and interest then. Debt will get easier to pay off. The second thing is to create a buffer. Most sophisticated investors understand a buffer will buy time. If you're new to the market, new to investing, consider reducing some of your budget, consider reducing some of your deposit to keep a buffer in place. If you're an existing investor, maybe redraw some equity and keep a buffer in place. We generally look at around a 3 or a 5 year buffer, which means if you're short of $5,000 a year, you're probably going to need around a $25,000 buffer to get you through the next 5 years, 10,000, 50, and so on and so forth. But that's really, really important. That's going to buy you time. I don't know if there's going to be a recession next year or in 10 years, but you need to be prepared for that because it will happen at some stage. And it's a great tool to bring that back and reduce risk. The last thing is probably the most uncomfortable. This is the biggest price you're going to have to pay, particularly if you don't have any of those options available. You're going to have to do something that none of us have done probably for the last 10 years, or most of us, live within your means. You're going to have to reduce your living expenses to fund the shortfall. But as all good property investors and mentors and successful business people say, you should be putting at least 10 to 20% of your income towards your investment or towards your future. So that is what you need to focus on. Unfortunately, there's too many distractions in the short term, and we're living in a world of instant gratification. People need to look past the instant gratification, have delayed gratification, and understand by sacrificing short-term decisions, they're going to be much better off later in life. They're going to have more choices. They can create greater wealth for them and their family. The biggest mistake is to target cash flow assets. Cash flow is a con. It's not the primary focus of what you need to do. And there's nothing more evident. Even if you had $5,000 or $10,000 better cash flow in the last 2 or 3 years, some properties have performed at 20, 30, 40%, and it doesn't hold a candle. So make sure you're focusing on growth over cash flow, tax depreciation, and other things. Finally, put all that together, understand that there are options available, but you need to be able to hold properties during that time, and there is going to be a cost to pay to get to the end goal. Otherwise, everybody would be doing it, it would be easy, and we'd all be wealthy, but that's not the case. So put a plan in place, put buffers in place, buy time, and have good quality assets in the market. Thanks for watching.